This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 318 was recorded on April 7th, 2022. I'm Erik Townsend. This episode of MacroVoices was brought to you by FarmTogether.com, where you can hedge against inflation and protect your portfolio by investing in U.S. farmland, now available to all accredited investors. And by Composer, making institutional-grade quantitative algorithmic trading and backtesting available to the masses. Bill Blain returns as this week's feature interview guest. We'll discuss inflation, what it means for the bond market, the impact of ESG on the energy market, and much more. Then be sure to stay tuned for our Postgame segment, when we'll have a quick update on a bear raid on the stock of Abaxx Technologies, a company that I and many of our regular listeners have invested in, followed by Patrick's chart deck, which is titled Bond Carnage in Macroland.
And I'm Patrick Ceresna. Erik, let's get to the S&P 500. After a 500-point rally in a couple of weeks to the upside, we were so overdue for a market correction, and here we are, well over 100 S&P points off the highs throughout the week. Is this just a market pause, or do you think that this can turn into something more?
I don't really have a strong view on equities here, but it looks to me, just looking at the chart, like the bear market rally's over. I think that there wasn't really a lot of fundamental reason for this. And I'll say that in my perspective, what's really going on right now, I think, is we have people who are looking at the geopolitical situation saying, okay, what's the story on the Ukraine war? Is the Ukraine war ending? Is it almost over? How close are we? And so forth. I would make the argument that they're missing the forest for the trees. I don't think there is a Ukraine war. I think it's World War III, and there's a Ukraine battle, which was the first hot conflict of World War III, and I don't think that the big picture is ending anytime soon. So I think we're in the reprieve here of looks like the really scary tension in the very first battle of this war, which I expect to last for several years, has maybe simmered down. I think it's going to get worse, and it's not necessarily going to be in Ukraine.
All right, well, let's move on to the dollar index. Now, the dollar index is almost at 100. It's working to a higher high. Do you think that this is a legit new breakout in your mind on the dollar? I mean, are we going back to like 102, 103, 104 where we traded in the past?
Oh, absolutely, if not higher. And the reason for that, though, is it's this war cycle. Now, if I've got it all wrong and it was just a Ukraine conflict and it's ending now and there is no World War III and that's all just paranoia, well, then maybe the dollar is a little bit, toppy here and about to run out of strength. I don't think that's a story at all. I think that maybe there's going to be a pullback here because I do think we're at a lull for the moment in terms of the geopolitical conflict, but I don't think it's over. And when we get into the next phase of it, I think there'll be another wave of dollar strength. So yes, I think we are going over 100. The thing that would change that would be if it turns out that this whole thing's just a big false alarm and there is no World War III, and I don't think that. Now, eventually, someday, you bet, I think that a digital currency will eventually replace the U.S. dollar. I wrote a book 4 years ago predicting that. Haven't changed that prediction, but that's not now. That's much later.
All right, well, let's move on to crude oil. Got to get your opinion on this because, really over the last 2 weeks, every rally's been failing, slow and methodical, almost distribution, lower highs, lower lows. We're under the 100 level. Is the big oil push over? Or are you still bullish in the bigger picture?
I'm definitely bullish in the bigger picture, but I wouldn't be surprised if maybe there's still a little bit further downside to go. Because let's face it, the first battle of World War III, at least the first live fire hot war battle of World War III, is in Ukraine, and at the moment we're kind of on a pause, although it looks to me like those peace talks are not going very well, and I won't be surprised if we get unpaused pretty quickly here. But as long as we're on pause in Ukraine, I think prices can still come down. As I've said before, there's a confluence of factors that could bring crude oil prices down in the short term, but I think eventually as World War III continues and the secular inflation that I think is either on the horizon or already here continues, I think we're going much higher on oil prices.
Erik, how did the inventory numbers come in?
Crude oil building 2.4 million barrels, with Cushing, Oklahoma building 1.7 million barrels. Now, remember, this is the time of year that you ought to be expecting builds. We've just been having some drawdowns lately, but builds should be expected this time of year. Gasoline drawing down 2 million barrels, distillates building 771,000 barrels. U.S. production ticking up another 100,000 barrels to 11.8 million barrels. Now, we're only about 1.5 million barrels, or less than 1.5 million barrels below that all-time high that so many analysts have said we're never, ever going to get back to. Not that far to go, so we may be headed back toward those all-time highs over 13 million barrels. We'll see what happens.
All right, well, let's move on to gold, because there was substantial gold volatility through February and March, both higher and lower. But really the last 3 weeks, you can pretty much define gold into a $50 range, just trading sideways and being incredibly quiet. I know you've shared your opinion before that you were disappointed by its lack of upside, but do you think there's more upside up for gold here, or you think it's just going to stay grinding here?
You know, my reaction to gold is kind of so what? It's basically just sitting on the cluster of short-term moving averages in a consolidation pattern. World War III didn't even push it to new all-time highs, although it got very close. And I'm generally unimpressed. I think that the fundamentals have all been in place for much higher gold prices, and we haven't seen them yet. I don't know what the problem is.
All right, well, let's touch on the 10-year Treasury yield, because last week we were testing 2.5%, kind of rolled over, and looked like maybe a short-term top in yields was there. And, well, in the last 2-3 sessions, a big breakout. We're at 265 basis points and running as bonds continue to get hammered here. When does this stop?
Patrick, I think the conclusion we can draw here is that the trend toward higher yields is pretty darn clear now. We had a lot of smart people when we were well below 2% telling us that, you know, if they're right, it's probably going to be 2.25 at most is where it tops out. That's as far as it can go. Well, guess what? It's past that. So that view was wrong. It seems like the folks that thought that inflation was going to result in increasing interest rates got it right. So I don't know how much farther it has to go, but this definitely is consistent with my view that inflation is not transitory and that we've got a real problem.
Well, this week's feature interview guest is Shard Capital's market strategist, Bill Blain. Erik, why did we get Bill back on the show this week?
Well, Patrick, Bill Blain has been a favorite guest when we had him on before. His Morning Porridge newsletter is extremely popular with investors, so it's been quite a while. It's time to get him back on the show.
Well, Erik's interview with Bill is coming up as MacroVoices continues right after this message from our sponsor.
With inflation reaching a 40-year high, investors are looking toward real assets to help safeguard their portfolio. One asset is rising in popularity. Farmland has consistently provided returns more than double the inflation rate since before 1992. How? Because farmland's value is underpinned by its critical role in the global economy. The country's growing population needs to eat. Farmland is well positioned to maintain its value over time, no matter the economic condition. As the supply of arable land in the United States shrinks each year, high-quality farmland should only become that much more valuable in the long run. Interested in adding farmland to your portfolio? Head to farmtogether.com. Farm Together is tapping into the nearly $3 trillion U.S. farmland market to bring unparalleled access to institutional quality farmland through a variety of products, including crowd-funded farmland offerings, 1031 exchange, sole ownership bespoke offerings, and most recently, the Sustainable Farmland Fund. Check out farmtogether.com today. You'll be glad you did.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Bill Blain, multi-asset strategist for Shard Capital and probably more famously known as the author of Blain's Morning Porridge, which is read by tens of thousands of institutional investors every single morning. Bill, you are a little different from the average macro investor who will sit in an ivory tower and proclaim to the world, you need to be investing in this macro backdrop in real assets, not financial assets, but real assets. You don't do it that way from your office. You get on a plane, boots on the ground. Why are you in Egypt right now, sir?
Great question. I've got to come clean with all the listeners. I am taking a week off.
Oh, come on. I set you up to say that you're committed to your investors, that you'll make all kinds of sacrifices to take
and I am. And you know what, Erik? Sometimes it's very important to get your head out of the markets and listen to what's going on. But let me tell the whole story. Yeah, I'm taking a week off to go down the Nile, because my wife did a degree in archaeology and she's fascinated, and I'm getting fascinated in it. But the reason I'm in Egypt is because we're thinking about what the future of investment looks like. And I've got to say, I am very nervous about financial assets. We've just had one of the longest bull markets in the equity world. We've seen bonds perform stupendously well since 2007, and everyone's made off like bandits. But of course, we've all got to be realistic. The reason the stock market's been so strong and the reason bonds have been so returning has been distortion caused by central banks, the consequences of what they did to keep the world afloat in 2007 with ultra-low interest rates, quantitative easing, and then artificially keeping interest rates so low. And then, of course, we had COVID. Now, these are all factors that distorted the markets. We're now beginning to see that correct. And so I think the outlook for financial assets, that's bonds and stocks, is no longer as exciting as it used to be, because as that distortion disappears, as the Fed and the Bank of England reduce their balance sheets, that distortion effect begins to vanish. So you've got to think about what kind of things should I be invested for the future in a highly inflationary market. And that's why I find myself in Egypt, because we're no longer just thinking financial assets or assets that generate a return, such as aircraft used to do before Putin confiscated half of them, but we're thinking about real assets that are going to generate future businesses. So one of the areas we're looking at is what is going to be the future of the oil business post-climate change, when we no longer see oil as a primary source of energy, but we see oil as a vital commodity for all the goods that we need for the modern economy, like paints, adhesives, plastics. And by plastics, I mean let's develop plastics that are biodegradable. So there's still a future for oil. So we're looking at a big investment that we'll get involved in there. And so for the last couple of months, I've been running around the Middle East, putting together what looks like it will be a very exciting project. And when we get it inked, I will be telling you, Erik, all about it first, because we will be targeting real returns for that. And you need these returns in what's going to be a long-term inflationary scenario that I can see developing as a result of current energy insecurity. So that's why I find myself at the banks of the River Nile tonight, looking out over the most fantastic view and, wondering what's going on in the rest of the world.
Well, with that introduction, I know you've listened to the show, so you know what's coming next. I'm asking just about everybody about inflation. Seems like the consensus of most of the macro guys I've talked to is they mostly think that it's pretty close to what the Fed's been telling us, transitory, except that, if I look at bond yields, it kind of looks like it's not. What's going on here?
Look, I think we've got a very, very changed world. We have a long-term inflationary scenario. And I think, to figure that out, we need to go back to basics. Inflation is not just about the supply chain blockages we've seen in the last 2 years. It's not about sudden shortages that have been created by the COVID backwash. What we're actually seeing create real inflation now are some fundamental changes in geopolitical trade patterns. We're also seeing this enormous energy insecurity shock hitting Europe in particular, but it's going to have knock-on effects elsewhere. And the one thing I always think economists, as a trade, we miss is consequences. So when you have gas prices, and I mean proper gas, as we Europeans call it, which is not gas, which is petrol, as you Americans mistakenly call it. But when we see gas for heating prices quadruple in Europe because of the shortages from taking Russian oil, that has not short-term effects, but long-term effects. Yes, we will bring in American liquid petroleum gas, LPG, but it will take 2 years to build the reception facilities in Germany to start importing it. We do have other facilities throughout Europe to import American and Qatari gas, but getting them into an infrastructure system to get it into Germany is going to take time. So you're going to see a maintenance of these elevated energy prices for some time. And that's feeding very quickly into the real economy, not just in terms of consumers. And I can tell you that in the UK, consumers who, let's say, normally pay £100 a month for their electricity are now getting hit with bills for £200-300. And in a society where we've seen zero wage growth for 15 years, but 2 to 3% real inflation, that means people are really beginning to struggle. But you're also seeing this effect on the supply side of the economy, where businesses are finding that their costs have shot up. So when I hear people talking about transitory inflation, or these are just short-term effects, will very quickly hit the top of the oil market, well, I'm just not seeing that. I think we're into a period where consequences drive further inflationary pressures. So you're going to start seeing demand for wages heating up. Now, I think what's really interesting, if you take a look at the employment numbers, not just in the US, but across the West, the Occidental West, every economy seems to be pretty much at full, they're all at full tilt. So you're bound to see inflationary wage pressures start to emerge. It already has. But one of the other factors I talked about right at the beginning of this little spiel was how the geopolitics have changed. I mean, we can see that immediately with the reaction to Russia, just how quickly we've tried to cut Russia off. And we can also see how difficult it is for the Europeans to actually close down the Russian gas spigots. But it is going to change the way that everybody thinks about their supply chains. I mean, chips are the obvious ones. Everyone wants to have their own chip making, their own foundries nationalized again. So global trade, the end of globalization, or the redefining of what globalization is, and people or nations beginning to understand that it's not just energy security, it's supply security, strategic goods security, and where they get all these things from. I mean, we're beginning to wake up to the fact that the world is an enormously complex place. And central bankers telling us, oh, we'll very quickly recover, assumes a very two-dimensional model. But in fact, it's multi-dimensional, all the things that move prices. I guess that's a long-winded way of saying I just don't agree that we're in for a short period of inflation. I think we're going to see long-term inflationary pressures. And my big concern is that in some nations, and I'm particularly worried about the UK, where we're beginning to really understand just how much damage Brexit has done to our export economy, and particularly parts of Europe, we're going to see, I think, stagflation, which is where you have this terrible combination of a declining economy and inflation. I remember it vaguely from my childhood in the 1970s.
Bill, I'd like to run my latest thoughts about inflation past you and ask for your critique, because they've actually changed quite a bit since the situation with Ukraine and Russia has broken out. Now, previous to that, as our regular listeners know, I've been thinking for a long time that we're headed toward secular inflation. And okay, I don't know if we're there completely yet now, but we're getting in that direction. And I don't believe the transitory thing. I think it's going to be persistent and probably secular, but I'm not smart enough to know that for sure. Bill, I think the war with Russia is the game changer. Wars are always inflationary, but in this particular case, the thing I see is, you can say you don't like Vladimir Putin. You can say you don't approve of his morals, of his tactics, and so forth, that he's a horrible guy, whatever you want to say. But he is a competent leader. He's not stupid. And he has accepted the loss of a huge, huge amount of business. He knew these sanctions were coming if he did what he did. He knew that he was going to lose all those international businesses. He knew all of those things. He didn't make those sacrifices just because he wanted to annex the Donbass region. He obviously has bigger plans. There's more to this. There's more coming. We haven't heard what Chapter 2 is going to be yet. That's my take. It seems like most of the world, and this is where I see a huge variant perception, most of the macro world is kind of feeling like, oh, phew, this thing with Ukraine's almost over now. The Russia thing's all calming down. I don't see it that way. I see that we're in a new, worse than Cold War era. It's a different kind of World War III, and I think it's super inflationary. What do you think?
I'm not going to agree with you completely on your analysis on Putin, but I do think it is a complete game changer. And let me start by trying to explain that. I think there's a very cozy consensus in the West that, oh, Putin's absolutely mad. The man's barking. What's he been doing? Why has he done this? This is terrible. I mean, we must stop him. We must stop him. And we, in the West, it's very easy for us to explain exactly what he's done wrong and why it's so unacceptable. From the Russian perspective, I think, frankly, if I can put it in British terms, Putin's been a bit of a chancer. He saw the writing on the wall. I think he looked at the Trump administration and said, okay, America is no longer going to stand behind NATO. We have energy security in our hands over Germany, therefore Europe's most productive zone. I think we can push here and we can get what we want. And he probably expected a negotiated settlement where he got the Donbass or whatever. And let's not forget, until recently, people were calling Ukraine one of the most corrupt nations on the earth. But I think that's all in the past now. The lines in the West are drawn. You're absolutely right. The economic effects on Russia are going to be highly significant. From my own perspective, knowing a little bit about Russian and Soviet economic history, I think they made a tremendous error. It's going to put them back decades, but they're no longer really significant. I think this is Russia out of the geopolitical game. It's in the rest of the world that it's important. And having spent a long time in the Middle East recently, you hear a very different view to the one that you hear in the Occidental West. You hear a perception, now everybody agrees that what Russia is doing in Ukraine is unforgivable. The apparent massacres, bombings, nobody is saying that's acceptable. But what people are saying is, the West has got itself into this problem. The West is responsible. And I turn around and say, how can you say that? You cannot invade anyone else's country this way. So, well, you guys can't agree on anything. And I start to lecture them on politics, and they turn around and they just say, Boris Johnson, Brexit, Donald Trump. And these are all very difficult to argue with investors from countries outside the Occident who are turning around and saying, we've got investments with Russia. We've got things that we're trying to do with China. We like the possibility of new markets. So if you look at what happened immediately after the Russian invasion, where President Biden immediately moved the latest Patriots to Saudi Arabia, yet still could not get Crown Prince bin Salman to take his call about increasing oil supply, that's where a lot of the inflation is going to be generated, because the rest of the world is not going to slavishly follow what's happening in the Occident. And by that, I mean Australia, Japan, North America, and Europe. The games have changed. And this is all part of what I was saying earlier about the geopolitics of trade absolutely moving around. So it's not just what Russia does in terms of the next 2 years of energy insecurity and inflation in Europe. It's about where the future goes, where the Gulf states go, where India aligns itself, and how, the big unknown is, how do the Chinese play? Well, it's clearly in the Chinese interest to continue as much instability as they can in Eastern Europe. But I think they've seen the effect of weaponizing the dollar. And the last thing they want at this stage in their economic conflict with the West is to find themselves in the same kind of exclusion zone from the dollarized economy. Now, there's a lot of chat about how this is a disaster for the dollar, about how it spells the end of dollar dominance, that the weaponization of the dollar will have people questioning it. I don't buy that at all. I think this just confirms to people that there isn't a real alternative to the dollar, at least not yet.
Let me just test that one because, first of all, I agree emphatically with everything you said. Just one caveat. I would go so far as to say, Bill, that I predict there will be no viable alternative to the U.S. dollar as the world's global reserve currency until we get a global scale, fully decentralized digital currency. Probably not Bitcoin, more likely to be a central bank-backed system. But I think it's a digital currency that eventually takes that title away. And as much as cryptocurrency is all the fad right now, the technology is not ready for prime time. We can't run the global economy on a proof-of-work validated blockchain. We need a proof of stake or whatever the next thing that comes after proof of stake is. Ethereum is getting there. We're making progress. It's years away. But I say that there's no replacement to the dollar until it gets replaced by a digital currency system. And that's where the entire world changes overnight completely and freaks everybody out and nobody knows what to do. It's probably at least a decade off, but I think that's coming. What do you think?
I don't see any real relevance to the cryptocurrency debate. I think they're terribly interesting, terribly interesting from in terms of how innovative and whatever it is they've managed to find something to use the blockchain for. But I don't think they're a solution desperately looking for a problem. I don't think they're anything except an evolutionary dead end. Sorry to be so negative, but I think some of the issues you raised there will be very interesting. I think what is going to happen is that governments are going to take the opportunity to digitize currency because it just makes it more. It becomes easier for them to control and to keep a complete record on who's doing what. It will simply move parts of the economy off balance sheet effectively into the dark parts. I'm not entirely sure how it's going to play out, but I don't see digital currencies being an answer to man's inherent desire to make money and not pay taxes. I guess that's how it boils down.
Well, I do think digital currency is a solution to Triffin's dilemma in the sense that you could have a supranational, fully decentralized global reserve system where no one nation is in charge of issuing the money for the rest of the world. Everybody has an equal stake in it.
Yeah, I'm going to struggle with that one because I think the money is so confused and complex at the moment because of the amount of just how indebted every single government, how indebted everybody effectively is. And if you take a look over the last 10 years, or the last 20 years, ever since its inception, one of the big conversation topics, usually after a few beers, is how long is the euro going to last? And you get statistics bandied around saying that any currency union only lasts 30, 40 years before it starts to creak under its own pressures. And we can see that happening with the euro. But you know what? The euro has proved tremendously resilient. And I think the euro is moving into a different phase where effectively it's managed to take financial sovereignty from all the European nations, and it's now moving to become a common money for them all. Now, that will create long-term stresses, and they will only succeed if the polity of Europe can get German taxpayers to pay Italian pensions. And I think they might actually get there. If you'd asked me that 3 years ago, I've said no chance the euro won't survive the next tensions. But in fact, the world changes. And as the facts of the world change, you have to amend your opinions. And I've actually gone positive euro, thinking, yeah, well, it might just happen because the kind of unanimity of the political response to Ukraine has really been quite encouraging. As for a single global currency, well, you know what? I'm getting on. I'm getting old, and I very much doubt I'll be around to ever see it happen. Which is another way of saying I just don't know.
Bill, let's move on now to where the rubber meets the road for investors. Let's start with the bond market. with all this discussion we're having of inflation and so forth, I've been surprised, actually. There's been some really smart people, really, really accomplished fixed income guys, like Alex Gurevich, for example, have come on the show and said, look, despite what's going on, yeah, there's inflation, but it's not going to last forever, and this is an incredible buying opportunity for bonds. The bond market's not going to crash. Everything is, this is the time to get in. I'm not seeing it that way. I'm struggling here. It seems like there's a lot of good sounding arguments, but the yields go in the other direction.
Okay, well, the bond market is the most important thing on the planet, bar nothing else. In bond markets, there is truth. But there's also an awful lot of rubbish written about the bond markets by people I don't think really understand them. Now, I've been forced to understand them. I've spent 40 years in bond markets, and they are actually, they're really basically simple at the end of the day. But what you need to understand is bond maths. And I say maths, not as you Americans say math. But bond maths is very simple. You pay an upfront cost, you get a return on a bond, and at the end of that period, you get your money back. That's the way a bond works. Every year, you get your interest on that bond. Now, people are looking at the collapse in prices of very long bonds, and they're thinking, oh, this must spell the end of the market. Great example. In 2020, the Austrians were able to launch a 100-year bond carrying a coupon of 0.085%. Yeah, that's 85 cents in every 100 euros for the next 100 years. And because interest rates were falling in Europe because of COVID, at one point, that bond went up from its issue price of 100% to 133%. Now, of course, interest rates have increased and the price of that bond is now 60%. Oh no, the price is halved. That's destruction and destruction. Well, you know what? If you were silly enough to buy a 100-year bond on the basis that interest rates weren't going to get any higher for the next 100 years, well, that's your outlook. But the key thing for the bond market is inflation. Now, think of inflation as the apex predator of bonds. If you have 5% inflation for 10 years, that's going to eat away something like 25%, 28% of your principal in terms of its real value. So when you get your $100 back in 10 years' time, you can only buy 72% of what you could buy today. That's the effect of inflation. It eats away at your principal. But here's the thing, you're still getting your $100 back. With equity, you just don't know. And so what's really important about bonds, though, is that they set the base level. U.S. Treasuries are a great example of the base rate, the risk-free rate in the market from which every other financial asset prices. Yes, even equities price off the rate that the bond is priced at. The big problem has been, for the last 13 years, interest rates have been kept artificially low by governments controlling that bond rate through quantitative easing, which basically means buying bonds in circulation to keep the price high, which means the yield is low. As a result, it's become a terribly distorted market, and it makes equities look more attractive. Now, as rates normalize, you're going to see that knock-on effect into equities, making equities more difficult, because they will look less valuable compared on a relative basis to the rising bond yield. And of course, you're apparently going to lose money on your bond because the price of a bond will fall, which means you have to hold them to maturity and run that inflation risk. I think the big worry here is that while people are still saying, and I disagree with them, that inflation will be transitory, if it's long term, the value of that bond takes a considerable hit over time. But because of all the distortion that the central banks have inflicted on markets, I rather suspect that they see the only solution to the enormous amounts that governments have borrowed and the effects of quantitative easing on the economies is going to be a good dose of fairly long-term inflation, which they will say they're trying to control by raising interest rates. So it's very important to look at what bond markets are doing because they set that risk-free rate, but also understand that at the moment bond markets are highly distorted. And I think that's why we're seeing so much panic in the market about non-functional bond markets. Now, bond markets are what we call sticky, especially the non-government bond markets, where prices will become distorted by how illiquid they are. That's what I mean by their stickiness. And this is certainly going to be something I think we'll see dominate the financial press in the coming months as it becomes clear that inflation is not going to be transitory.
As a public service announcement for our listeners, I'm not sure whether or not those 8 basis point 100-year bonds are still on offer in Austria. But if you're interested in buying an 8 basis point 100-year bond, we'll be happy to sell you a MacroVoices 100-year 8 basis point bond. Contact, can't say that. We'd be marketing unregistered securities. Scratch that. We didn't mean it. Just kidding, folks.
Okay, well, I'll tell you what, Erik, you can get them to give me a call because I can sell them that 8.8% bond at a yield of 1.63. 1.63% every year for the next 98 years. Lovely. That's a bad buy.
Yeah, but we'll give you the full 100 years. You're selling off the run. You only got 98 years. I'll give you 100 years worth for 8 basis points. Let's move on to something that's really important, Bill. I want to go on record as saying this ESG trend. I don't think there is any greater calling or better idea that's ever existed than the notion that investors, owners of capital, should finally take responsibility for the way that they invest that money to do good for the world. I'm all for it. Yay. There is no greater calling than investors focusing on environmental, social, and corporate governance values. I get it. I'm on board. But you know what? I think this entire ESG trend on Wall Street is 100.0% unadulterated bullshit. I think it is a con job being perpetrated on investors by Wall Street. And I think that the guys selling most of that stuff really believe that ESG stands for extremely stupid and gullible, which is what they think of their clients when they're selling them greenwashed crap that has nothing to do with advancing any of those goals. And particularly, what I'm seeing is that they're vilifying energy producers. And I think that's going to create an energy crisis that could be a major historical event in the course of world history. Am I crazy to think that it's that bad?
You know what, Erik? It's actually worse. It's actually worse than what's happening with ESG. Now, I am an absolute believer in stakeholder capitalism. I am probably one of the very few people working in the city of London who got slung out in the Labour Party in his youth for being too left-wing. As one of my good friends once told me as we were laughing about it, we were all former socialists. Some of us have grown up, but not all of us. But I absolutely believe that ESG, environmental, social, and good corporate governance, should play a major role. But here's what's actually happened. It's been taken over by the marketing departments of big funds. They all see that saying they've got very clean ESG credentials is going to attract concerned money in because, everyone is concerned about climate change. Everyone's concerned about the future prosperity of the planet. And this is something we can talk about, and I'll use Egypt as an example in a moment. And everyone's concerned about good corporate governance. And if we can invest to make all these things better, hey, that's a great point. But what's happened? Let's start off with energy. Everyone's immediately said, right, ESG means environmental goodness. So we got to be good. That means no more fossil fuel, no more coal, no more oil, no more gas. You got to go and build renewable power. Well, you know what? Everyone stopped then funding coal, oil, and gas. The result is a situation we now find ourselves where we have energy insecurity. And they've all gone out and they've piled into wind farms and solar arrays, covering up the countryside with solar farms. And these are not proving as good as everyone thought they would. And the problem is everyone wants to show that they've got these green renewable assets on their balance sheet, which means they all bought them at massively overpriced levels. And then they're discovering that a wind farm out in the ocean is really, really difficult to maintain because there aren't enough boats to go and do it. And they're finding that to make a wind farm, you need something like 140 tons. To make a single wind turbine, you need something like 140 tons of steel. And you know what? You can't make steel without mining the iron ore and then refining it with coal, metallurgical coal. You need about 200 tons for every single 100 tons of steel that you produce. So you can't buy metallurgical coal that is dug up in the West anymore. You got to buy it from Australia, and then you get your steel made in China, which creates an enormous amount of carbon miles. And that's just one little example of what's happened. ESG thematics have overtaken common sense about turning it. Now, the big thing here, of course, is climate change. We need to get to carbon zero by 2050, as all the conferences are telling us. Well, you know what? We can do that, and it is going to be difficult, but it means using gas as a transition fuel, and it's going to take a long time for us to build the renewable energy capacities that we need to replace the current things. It takes 20 years to build it, or 15 years to build a nuclear power station in Europe. That's the kind of thing we need. And until we get them in place, we need gas. But we don't have any gas because we stopped investing. That's a disaster. Now, there are other parts of ESG, the social and the governance. I mean, let's just talk about governance for a moment. How can you have a company like Boeing, which is one of my favorites to attack, that spent billions in stock buybacks and paying massive bonuses to its C-suite senior executives, rather than developing a new plane and just fixing up and make and mend an old one, resulting in 346 people being killed by a system that they never told pilots about? That is bad corporate governance. Yet if you take a look at Boeing's stock price, you wouldn't know it. And then in terms of social, if you're going to promote social investment, then we really need to look at how do you create a better future for everybody when corporates are doing things as we just had in the UK, as 800 seafarers who man the ferries from Dover to France being sacked overnight and replaced by foreign workers at 1/3 of the UK minimum wage. I mean, that is not good social service for anybody. So ESG is in great theory, but as always happens, the market has arbitraged it to its advantage. So we're out selling ESG funds to investors who think that they're funding a better world, but actually all they're doing is funding more and more energy distortion when it comes to environment. And we've got to do more to ensure that corporates do good in terms of the way they run themselves and do social good as well. And part of the social good is paying proper taxes. Now, when you discover how little some of the big multinationals pay in taxes, it should really get people angry. Anyway, I could go on and rant about ESG for hours.
What is going to happen to energy prices? Because a lot of people think as the 150-year period of energy all coming from rock oil, or most of it coming from rock oil, ends, that means the price has to collapse. I think it's the opposite. I think what's going to happen is the lack of investment is going to mean that essentially we have phased out fossil fuels before we've fully phased in the replacement, and the result is that there are massive shortages. What do you think?
Well, I'm actually still trying to figure this one out myself, and I think it's all part of this ESG debate. It's a continuation of it. It's about how we transition energy security. 20 years ago, the world was thinking about how do we get out of our reliance on fossil fuel energy, and that's when all the original ideas about wind and solar as good renewable sources came up. And effectively, because wind and solar is easy, we've done that. We've spent very little developing alternatives like tidal energy, which is ultra reliable, which wind and solar is not. And we've basically scaled back completely on nuclear. It's only just beginning to get the attention. We keep making noises about putting money into things like hydrogen power as well. But everyone's got this kind of idea, no, it's going to be okay. We've got wind and solar. That's great, renewables. We'll just make more and more of them. Oh, and then we'll make lots of batteries to store all the energy they make. And that's when I go, hey, wake up, smell the coffee, boys and girls, because lithium is a terrible substance. We all know that to mine lithium in some of the Congolese mines is a social no-no of the worst order. It's filthy, it's disgusting. You've got kids digging this stuff up, and that's only one little part of it. We can go and get lithium from other places, like turning the famous Atacama salt flats into a massive lithium processing mine, which will destroy one of the most unique landscapes on the planet. Hey, yeah, but we'll get lithium out of it. But the fact is, demand for lithium is going through the roof. The price is going to double, and that's going to make the price of an electric vehicle go through the roof as well. And we're suddenly going to wake up and say, oh, well, the same economics of scarcity apply to lithium as apply elsewhere. And I think that's going to be a wake up and see moment. And then we've got hydrogen, which is a very interesting potential source of energy. But to make hydrogen, you basically have to burn fossil fuels to make it, or you make more renewables to make hydrogen. And that makes each stage of the energy transition process less and less efficient. So if you have to make electricity from a wind farm and then use that electricity to hydrolyze water to get hydrogen, which you then need to convert into ammonia to transfer around the world to make ammonia and fuel cells to do exactly the same thing as an internal combustion engine does. You know, these are all very complex solutions that aren't really getting us anywhere yet. Eventually, I think we will find a hydrogen solution. But I think at some stage, someone's going to, and this needs to be government policy, governments are going to have to say, we need to make a massive investment in nuclear fuels. And yes, that does hold us hostage to uranium supply. And then we need to be making a Manhattan Project style effort to get fusion working, which, you know, promises to be unlimited fuel. The problem is it's always tomorrow and tomorrow and tomorrow rather than when we need it, which is today. So there is no easy energy solution. We simply can't go on burning gas the way that we've been doing in the past, but we simply can't switch it off and expect the world to transition overnight. This is going to be a 30, 40, 50-year transition process before we have proper clean energy. And as I was saying right at the beginning, we are still going to be using oil for all the other things that a proper modern society needs. Oil derivatives, the petrochemicals that keep engines running, that keep things lubricated, that you make adhesives out of, that you make the tires for your car out of, you make paints, all these things. I mean, oil is not going to go away anytime soon.
Bill, I agree with just about everything you said. I was curious about your comment on fusion being the best path of solution. What I would have said is I'd agree with you that there's no easy solution. It's not something that you simply do overnight. But I would say the thing to focus on is first you got to overcome the psychological society problem with people are afraid of something they don't understand, which is nuclear energy. But specifically, I think what we need to do is get rid of boiling water uranium reactors like these big Westinghouse reactors, and we need to replace them with liquid fluoride thorium reactors, which still use fission. It's not fusion. It's the old kind of nuclear energy, but it's dramatically safer. Now, the only thing standing between us and that is the government getting its shit together. And I think the reason the government doesn't get its shit together is because society is afraid of anything that has atomic or nuclear in its name. Are you aware of the thorium technology, Bill? And would you agree that that might be maybe a little closer in hand than fusion, or am I missing something?
No, I've not done any in-depth thinking about the thorium salt solutions, but I think there's 3 stages that we need to consider, and we need to completely reinvigorate the whole argument about nuclear power, which is basically set in policy decisions that were made in the 1940s and 50s about the supply of weapons-grade plutonium. We need to rethink it from first principles, which means looking at other technologies. And one of the other very exciting ones is we have a proposal from Rolls-Royce in the UK to build what were called mini nukes. They make the reactors for the British nuclear submarines, and they could effectively make much smaller reactors that could be built quickly rather than the very long lead-in times that we have. And I'm sure there are other technologies that are worth exploring until we get to this holy grail of a costless nuclear future with free power. But, you know, that's something that's always going to come tomorrow rather than immediately. But we need to be rethinking the whole nuclear debate because, one of the things I was talking about earlier there was lithium. We haven't even got on to discussing the costs of disposing of lithium, because what you get whenever you discuss lithium is, it'll be fine, we'll recycle it. Hang on a second, do you know how difficult it is to recycle it? These questions aren't getting answered properly in the public markets, so we actually need to have some intervention in government about proper transition strategies to secure energy for the future.
Well, Bill, I can't thank you enough for a terrific interview, but before I let you go, please tell our listeners a little bit more about what you do at Shard Capital, and particularly what our listeners will find at www.morningporridge.com.
Okay, thanks very much for that, Erik. I wear multiple hats. The first thing I am is strategist for Shard Capital. We're a firm in the City of London. We now run a number of different investment strategies. I also wear the hat of being head of capital markets, which is why I'm running around trying to construct big deals. But it also means I'm in direct contact with markets rather than just the theory of them. And the third thing I do that I started about 15 years ago was my morning comment that originally just went to my clients, but now is freely available to anyone to read on www.morningporridge.com. And I publish something every morning. Or if you want to pay a minimal subscription, you can get it sent to your email fresh every morning. And that's Blain's Morning Porridge. Porridge, of course, being the Scottish food of champions.
Well, Bill, I can't thank you enough for a terrific interview. Patrick Ceresna and I will be back as MacroVoices continues right after this message from our sponsor. For decades, quantitative hedge funds like Renaissance, Citadel, and Two Sigma have benefited from the development of systematic or rules-based trading. Renaissance's Medallion Fund returned 66% per year from 1998 through 2018. Medallion is run by an army of data scientists, mathematicians, and neural engineers that build code to take advantage of exogenous market movements. There's a reason why over $1 trillion is managed in quantitative hedge funds. However, unless you have a PhD or a Python expert, building trading algorithms has been next to impossible. Until now. Composer is a VC-backed startup that lets anyone build quantitative strategies for free. No code or Excel required. With Composer, you can easily build strategies with their drag-and-drop no-code visual editor, or invest in their pre-vetted strategies like paired switching S&P 500 and bonds, or buy the dips NASDAQ. To learn more, go to composer.trade today. That's composer.trade today.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was great to have Bill back on the show. His insights on the bond markets were just so relevant. And really, I love it when you can step back and have such a bigger picture view on what's going on there on that. Now, before we go on to this week's post-game chart deck, we need to manage perceptions around some events in the market this week. Abaxx Technology was hit by a bear raid this week, forcing the price of Abaxx stock much lower. By pure coincidence, this happened the first week after Abaxx advertising contract MacroVoices concluded at the end of the first quarter. And I'm concerned our listeners are going to wonder if these things are related. Erik, are they related?
No, Patrick, they're not related. As you said, the reason that both Abaxx and Masterworks are no longer advertisers on MacroVoices and have been replaced by Farm Together and Composer this week is simply that the first quarter ended and the ad contracts lapsed. We're still on good terms with Abaxx, and I personally bought another 200,000 shares of Abaxx stock in the first quarter on top of the 1.6 million shares that I already had. So Abaxx advertising contract ending had absolutely nothing to do with the bear raid on the company's stock. It was just a pure coincidence that it happened at the same time.
Now, some of the Twitter banter has been focused on Short's allegations that James Dwade, a private investor who's been an outspoken advocate of Abaxx, supposedly sold all of his shares and then deleted his Twitter account. People are reading all sorts of meaning into the account being deleted. What's the story there?
Well, my heart really goes out to James, and I've exchanged an email or two with James to try to better understand what happened here. He said, first of all, he still has more than 42,000 shares of Abaxx stock. He did have to trim his position and sell some of it last week, but that was a necessary matter of risk control because the price is going down, and I guess his eyes were a little bit too big for his stomach, and perhaps he was a little bit over-allocated to Abaxx stock because he was so bullish about it. Now, what apparently happened here is that a short seller befriended James online, gained his confidence, and then persuaded James to engage in some phone calls about Abaxx and its prospects. The other guy was posing as a fellow Abaxx bull who wanted to collaborate with James on this investment. Then, after gaining James' confidence and trust, he apparently persuaded James to share some confidential text exchanges that James had had with Abaxx CEO Josh Crum. The shorts are, of course, now posting those confidential exchanges all over Twitter and the internet, trying to allege that supposedly it represents damaging information or something. Now, Patrick, just hearing James' story reminded me of my own indoctrination into the big leagues of finance after selling my software company and having a very unpleasant relationship with private bankers whom I foolishly thought were on my side in the beginning. So James Dwade appears to have been played by the shorts, and I really feel for the guy. I don't blame him one bit for deleting his Twitter account and wanting nothing more to do with sharing his excellent investment research with others for free, as he's been doing for a very long time. And I think it's a real shame that he was exploited in this way and that that's costing a lot of other people access to his insights.
Okay, thanks for clarifying that, Erik. But let's face it, Abaxx didn't launch their new commodity futures exchange in the time frame they first anticipated. What went wrong there? Are you concerned about the company's prospects now that they've missed their product delivery targets?
I'm going to answer that question directly in just a moment, but I think the story of my first angel investment more than a decade ago is incredibly relevant to this story, so I'm going to start there. Back in 2007, I met a young entrepreneur named Alper Turgut at the New York Angels Group run by David Rose. Alper stood out from the other angel pitches that I'd seen, and I was very impressed with his team's invention of some AI software that could actually recognize celebrities like John Travolta and so forth on video streams and automatically detect and report copyright violations without using the digital watermark approach to this problem, which has been easily defeated by hackers. So I was very impressed with that idea, and I ponied up $50,000 to help the launch of Envato, which was Alper's company whose business plan was to build a system that automatically found copyright violations and basically sell it to Hollywood. But before long, things were changing, and I started to get really concerned. The company was suddenly not sharing any more information than it had to by law with its angel investors, and quite a few of us got nervous over that. When we found out that the company had abandoned the business plan that we invested in and was using our money to do something else entirely, I completely lost my shit, Patrick. I felt like it was an overt bait and switch. The shares were completely illiquid. There was nothing I could do. I couldn't get out. I considered offering my shares, this is a couple years into the deal, to other angels at half of what I'd paid for them, just to get out of what seemed to me like a certain, this thing's going to zero. You know, it was a bait and switch. I got screwed kind of thing. Right up to the day that I got the email saying that Alper had turned my $50,000 into almost $900,000 after inking the deal to sell Envato to Google. You see, Alper was executing flawlessly the whole time. He knew his market, and he knew it really well. When the market changed, he changed his strategy accordingly, and that was a very good thing. It wasn't a bait and switch. It was merely a case of a really talented entrepreneur doing his job and recognizing that the best use of the capital that he'd already raised was to change his strategy slightly based on changing market conditions. And the result of that was that he ended up with a liquidity event at a much larger number than any of us ever expected. Now, it's true that all the other angels and I were left in the dark. Alper was refusing to tell us the company's internal secrets, insisting on playing those matters close to his own chest and not telling us what was going on. We didn't even know that he was in negotiations with Google for an acquisition until after we got the email saying, where do we want our money sent when the deal closed? The moral of the story is Alper did everything exactly right. The reason he refused to share important competitive information with us as the angels is that business is competitive, and sometimes people do really shitty things. James Dwade's experience with the short-selling con artists on Twitter clearly illustrates that. So let's return now to your direct question so that nobody accuses me of ducking it. You asked whether or not Abaxx missing some of their important milestones in their original business plan is cause for serious concern or not. What I can tell you with high confidence is that what's going on here is very analogous to the story that I just told you about Alper Turgut at Envato. What Josh Crumb is doing as CEO of Abaxx is responding to a rapidly changing DeFi landscape. And as part of that process, the company has taken on things that it never planned on taking on because Josh sees incredibly ripe opportunities. And to be sure, another thing that's happened as a result is that because Abaxx is now pursuing these new opportunities beyond its original plans, the unfortunate result has been delays on that original business plan. So the real question for Abaxx investors to invest here is this. Is Josh Crumb executing flawlessly the way Alper Turgut did, keeping the company's secrets close to his chest and not revealing them to us because that's in our benefit? Or is he screwing up? Is he about to turn this thing into an 18-bagger like Alper did with Envato? Or is he driving Abaxx into the ground? The answer, quite frankly, is we don't know and we can't know. The CEO is a guy who has the backing of several billionaires, including Robert Friedland, Lucas Lundin, and Kyle Bass. So if Josh Crumb is an incompetent CEO who blew these deliverable dates for the sake of something that wasn't worth the compromise, then he managed to con some pretty darn sophisticated investors into backing him in this venture. So for now, my bet is that just like Alper Turgut, Josh Crumb probably has a really good reason for unprioritizing the delivery of the commodity exchange and putting the company's resources onto other priorities. I don't know that for certain, and Josh wouldn't be willing to tell me if I asked him because it's company confidential. We're going to have to find out.
Okay, so as far as you're concerned, Erik, Abaxx is getting it right, and the short rate is just that, a short rate. Is that right?
Well, look, when you have the luxury of hindsight, you can always find something to criticize. But if I was going to criticize Josh and the Abaxx team, I would say that their big mistake was taking the company public way too early. They're still running it in many ways like a private company. Their investor relations is basically non-existent. My understanding is that they felt that because most of the early angel investors were very experienced family offices, they decided to IPO early, really for the sake of giving those early investors access to early liquidity. But they don't really think their real IPO is until they go, public on the NASDAQ, which hasn't happened yet. If there's a lesson to be learned here, I think it's that even with sophisticated family offices in the picture, sometimes people screw up an IPO by dumping the stock, and that does appear to have happened in the case of Abaxx. So I think that putting the company on a public trading exchange before it's well enough known to attract institutional coverage, in my opinion, has proven to be a mistake in this story. But I think that's where the mistake is. As far as what the company's doing and whether or not they're changing priorities in terms of what they're trying to accomplish and what markets they're in, that's a question of the CEO's competence that we're not going to find out the answer to until it becomes known by the results. And that's just the way that private equity investment works. So the nonsense on Twitter about James Dwade losing his faith and dumping his stock and then deleting his Twitter account in shame is just bullshit. James deleted his Twitter account because he'd just been through the private investor equivalent of date rape with this short seller guy. And I don't blame him for wanting nothing to do with Twitter at this point. I'm not going to respond to any of the Twitter dialogue, and I'm going to block the short seller as soon as this episode airs. I delayed blocking him until we aired this segment just for sake of managing appearances and not giving the impression that we're hiding from this nonsense. As we've already spent way more time on this subject than it deserves, let's move on now, Patrick, to this week's Postgame chart deck. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, MacroVoices.com. Look for the red button that says Looking for the Downloads. Patrick, the chart deck is titled Bond Carnage in Macroland. What's going on here?
We'll get to the bonds at the end of the chart book, but let me just quickly take all of our listeners through a couple things going on. Now, one thing that I was highlighting over the last 2-3 weeks was essentially that after you have a 500 S&P point rally in a span of a couple of weeks, inevitably some sort of mean reverting correction is just natural for the markets. That's the way they behave, the things they do. To me, the big question here is that will we see this behave as though it is this type of a correction, or is it going to turn into something more ominous and the selling starts breaking key levels? For me, this very level where we're trading near this 44.50 level is a point of high interest to me, but then some pretty good supports come in around 43.20 and 4400. My first inclination is that we should get a stock market bullet bounce up. Whether that makes a higher high, whether the market is going to have another bull leg, is the jury's still out, and I'm not sure I want to stick my neck out. But I think that the bigger market sell-off that the market is vulnerable to is likely still maybe a sell in May and go away window, and that it may not emerge in April in this time frame. But we'll call the play-by-play here on the show each week. But going on, I wanted to just touch on page 3 to the euro, because what's interesting to me is that the dollar index has broken to a higher high. We've talked about it at the beginning market wrap of how strong the dollar has been. But what's interesting is that whether you look at this euro USD, which has not broken to a lower low, the pound sterling hasn't broken to a lower low, and the yen, while the US dollar yen has been rallying, it hasn't made a higher high yet. And so while the dollar index has broken out, the three of the majors inside the basket have, to me, not confirmed. I really want to see whether some of these currencies start to break to lower lows to really validate that next move in the dollar. Moving on, though, Erik, to page 4, I have crude oil, and I wanted to share my view with you and see whether or not this kind of plays out in your mind. So to me, if the bulls were going to keep control of the short-term trend, because I also agree a lot with your view that the big picture still has plenty of room for crude oil to go to higher prices. The big question in my mind is the short-term trend going to be a continuation higher, or are we going to spend time just backfilling and retracing that incredibly overbought short-term state? And really, with now the last week or two where crude oil has failed to follow through on any rallies and now under 100, I think it increases the likelihood that the next couple weeks, if not month, is just going to be a lot of chop. Maybe I don't think we're going to see much time, let's say, below 90 on any sustained basis. So it probably is very close to the bottom end of its ranges. But my view is sort of that this could be just grinding here for weeks before something more bullish starts to emerge on the chart. Would that fit in with your narrative at all?
My view is very similar to that, Patrick. I think we've already sold off down to kind of fair value. If you look before the whole Ukraine-Russia thing blew up there in the chart starting at the beginning of March, you just extend that trend that was already in play. We're back down to that trend line that was already there. So we've already, basically taken the war pricing mostly out of the market. I still think, though, that what we're seeing in the technicals suggests that what's going to happen is the market is going to continue to grind and churn lower, not crashing, but just continuing to grind lower until something happens. And the something happens, I mean geopolitically, when there's new news or a change in this. Now, if there was actually an outright, we've come to a new global peace accord. Everybody agrees that not only is the Russia and Ukraine conflict over, but World War III is over, and everybody has agreed to a new arms limitation treaty, and everything is wonderful. Oil's going probably quite a bit lower on that news. I don't think it's going to happen. I think it's a question of time until we get news in the opposite direction. But speaking of energy futures, Patrick, let's move on to page 5 and uranium. Boy, looking at the Sprott Uranium Trust as a proxy for uranium prices, looks like we're hitting a cycle high.
Oh yeah, and what's interesting is nat gas has been also incredibly strong as well. But this trend has just been so strong, higher highs, higher lows, working its way to a major overhead resistance. And then this week we got the breakout. Uranium is working, and it continues to be a place where money is flowing. Now I don't know whether this is the moment to go and start putting brand new positions to work. It's sort of like if you weren't in the uranium story over the last month or two, it's the kind of the bus has left the station without you. But it's definitely a bull breakout that on the short term can tack on $1 or $2 more on the upside and continues to be very bullish. But Erik, what I really did want to talk about, because Bill inspired me when I was listening to the interview, just talking about bonds, to just really touch on what is going on here. And instead of looking at the yields, I wanted to just kind of turn those charts upside down and actually look at the notes and bonds themselves, in not only the U.S. Treasury, but what's happening around the world. And what we continue to see is these bonds are being crushed. Obviously, the dot plots are moving. Everyone knows that Fed is going to move on these interest rates, and inflation's running hot. A perfect recipe for weak bonds. But it's actually amazing the magnitude and speed of the drops that we're seeing, whether it's the 2-year, 5-year, 10-year, or the 30-year that we have on those pages. It's just getting really ugly. And what's a little bit surprising to me, Erik, is that I would have thought that the stock market would have cared more about this. And it just seemed over the last many weeks that the stock market kind of is almost marching to the beat of its own drum and not noticing this. But inevitably, valuations start to substantially go up when on a relative basis when these kind of moves in interest rates and yields are occurring. And I'm certainly curious when the stock market is going to start to care.
Well, usually when stocks and bonds don't agree, bonds have a pretty good track record of being right.
Yeah, absolutely. I wanted to just touch on the last two charts on page 10 and 11. Just what an extraordinary move on German bonds. We went from a negative 60 basis point yield to now being at a positive 70 basis point. And again, obviously it's under 1%, and everyone kind of can easily roll their eyes on that's not going to have that big of an impact on the markets. But I think that it's a big shift in sentiment, because we were stuck in that disinflationary period where negative yields were just something that could be a reality. But it's most of the world is now entering the positive yield, and I'm kind of asking that question as to whether negative interest rates are now a thing of the past, where we look back in the history books and talk about that window for a half decade where we saw just such deep negative interest rates, and will we ever see it again?
Well, Patrick, I think that is the gazillion-dollar question: is did we see already the peak in the bond market, the final top and the end of the 37-year, is it, bull market in bonds? Seems like the signs are getting pretty strong that maybe we did. Listeners, if you enjoy Patrick's chart decks, be sure to try out a free trial of Big Picture Trading, Patrick's service. You'll be able to get Patrick's chart decks every single day of the week with his webinar service. You can find the information on page 12 or at bigpicturetrading.com. We're going to leave it there for this week's show. This episode of MacroVoices was made possible by FarmTogether.com. Diversify your portfolio with U.S. farmland, one of the most inflation-protected and recession-resilient asset classes in the world, now available to all accredited investors. And by Composer, making institutional-grade quantitative algorithmic trading and backtesting available to the masses. Patrick, tell them what's in this week's Research Roundup.
Well, this week you're going to find the transcript for today's interview, as well as a link to the chart book that we just discussed in our postgame. There's also a number of links to some articles that we found interesting, so you'll find this and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend. That's Erik spelled with a K, and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.